The secret of the global economic cycle lies in the ability to recognize each phase like the changing of the seasons. Each cycle, from recession, recovery, overheating to stagnation, brings opportunities for those who know how to seize them and risks for those who are uninformed. Timing your investment is more important than choosing the right type of asset, because even with the same type of asset, buying at the wrong cycle can still lead to heavy losses. By mastering the cycle map and observing GDP along with inflation, you will know when to buy and when to retreat. Have you ever wondered, why does the financial market go up and down like a roller coaster? Why does the economy sometimes boom, then suddenly fall into recession? It all lies within a loop called the global economic cycle. And if you understand this cycle, you will invest smarter than 90% of the market. In today's video, we will explore the 4 main stages of the economic cycle, and especially the appropriate investment strategies for each stage. Watch until the end of the video so you don't miss any opportunities. What is the economic cycle? It is the repeated movement of the economy through 4 stages: recovery, strong growth, slowdown, and recession. Each stage lasts from several quarters to several years, and no one knows the exact timing of the transitions. However, we can definitely determine our position in the cycle based on economic indicators such as GDP, inflation, interest rates, unemployment rate, and monetary policy. Imagine the economic cycle as a continuously turning wheel. Knowing your position, you will know whether to hold stocks, bonds, or cash. The first stage is recovery, occurring after a recession. The economy begins to warm up, GDP rises slightly, unemployment decreases, inflation is low. At this time, central banks still maintain low interest rates to support growth. Investor sentiment is cautious, but gradually improving. The ideal investment strategy in this stage is buy stocks in growth sectors such as technology and discretionary consumer goods. Invest in growth ETFs or small and mid-cap equity funds. Consider real estate or real estate stocks. Avoid long-term bonds because yields remain low. For example, after the 2008 financial crisis, the U.S. market began to recover in 2009. Those who patiently bought at that time earned significant profits over the next 5 years. After recovery comes the strong growth stage, also called mid-cycle growth. At this time, GDP grows steadily, employment is abundant, consumer confidence is high. But at the same time, inflation begins to rise, causing central banks to consider raising interest rates to maintain stability. The current investment strategy is maintain a high proportion of stocks, prioritizing large-cap, blue-chip stocks and sectors such as finance and industry. Index ETFs like the S&P 500 and VN30 often deliver good returns. Gradually reduce long-term bonds due to rising interest rate risks. For example, during 2016 to 2018, the U.S. economy grew steadily. The Dow Jones Index reached many highs, an ideal time to hold stocks and wait for profits. This is the most dangerous stage if you don't recognize it in time. Growth slows, capital costs rise, inflation escalates. Businesses face profit pressure. Consumers begin to tighten spending. The appropriate investment strategy is shift to defensive stocks such as healthcare, utilities, and essential consumer goods. Increase cash holdings or invest in gold, oil, and industrial metals to hedge risks. Prioritize short-term bonds or bond funds with good liquidity. For example, at the end of 2019, before the COVID pandemic, the U.S. economy began to cool down. Investors who shifted to defensive stocks or gold protected their assets. When the 2020 shock occurred, the final stage is recession. GDP is negative for 2 consecutive quarters. Unemployment rises sharply. Many businesses go bankrupt. The stock market plunges, investors panic. But it is here that great opportunities begin to form. Governments intervene by lowering interest rates, loosening monetary policy, and launching relief packages. The strategy at this time is: increase the proportion of long-term government bonds because low interest rates will push bond prices up. D. Gradually buy stocks with solid fundamentals and stable dividends to anticipate the new cycle. Hold cash and wait for big opportunities. Remember, those who invested in March 2020, right when the COVID pandemic broke out, doubled their assets within 12 to 18 months. To know where the economy is in the cycle, follow these indicators. GDP, is it rising or falling? Inflation, CPI, is it exceeding the target? Interest rates, is the Fed or central bank loosening or tightening? Unemployment rate, is there a sudden increase? PMI, corporate revenue reports, are they good or starting to shrink? Instead of putting all your assets into one type of investment, you should build a diversified portfolio. For example, 60% stocks, 30% bonds, 10% commodities like gold, oil, real estate. This is the mindset of the never-die investor, as Ray Dalio shares in the all-weather portfolio strategy. Every cycle carries risks and opportunities. Don't try to guess the bottom or top. Prepare a portfolio suitable for the current stage. Be patient, disciplined, and flexible in thinking. Thank you for taking the time to watch my video up to this point. I truly appreciate it and sincerely wish all of you who enjoy the video to soon achieve financial freedom. If in what I shared today you found even a few sentences that bring value and help your life a little better, then for me, that is great happiness.